Okay, here we go with part 2 of chapter 10 slides. I'm giving up on trying to record the narrated PowerPoint at the same time. I'm opting, right, because I couldn't come in and out and look at tables if I needed to. If you really like the narrated PowerPoints as opposed to the video, let me know, and I can try to get those back. But for now, I'm going to stick with the video since it seems better overall. Right. Once again, I welcome any feedback. All right, so here's chapter 10, part 2. All right, if we remember from a quick review from last time, to calculate my cost recovery, right, such as depreciation for an asset, I have to know the recovery period, right, which I'm just going to look that up from a simple table. It's usually going to be 5 years or 7 years for personal property. I need to know the convention. Well, my convention is for personal property, my default's going to be half year. Now, if I put enough assets in service in the fourth quarter, then I might have to switch to the mid-quarter convention. So once I know the convention and the recovery period, I can just look up in a table and it'll tell me what rate to use, what percentage. Then I'll always multiply that percentage every year. The right percentage will always be times the original basis. And they've tried to make these tables to make things as simple as possible. So with personal property, most commonly I'll have a 5 or 7 year recovery period. Our problems are always going to have one of these two. And sometimes it could be 3, 10, 15, or 20. The method, we're always going to use double declining balance because, right, taxpayers can. And assuming you have enough income, that's usually best, right? You get more deductions faster. Our convention, as we said, is the default is half year for personal property. But if we put more than 40% of the property placed in service that year was in the fourth quarter, then I have to switch to the mid-quarter convention for all my property placed in service that year, and it'll be under mid-quarter for the rest of its life. Real property will have a 27.5 or a 39-year life. Rarely it could be 31.5. We'll get back into that. It will always be straight line method and always be the mid-month convention. So it's pretty simple. Once we know the convention and the recovery period, we just look at the table and it becomes easy. All right, so here's an example of a table for the half-year convention for personal property. And down here is the table for looking up the recovery period. All right, so let's do an example with these. If Acme buys a computer on January 1st for $4,000, calculate their deduction for depreciation for year 1. All right, so $4,000 is my initial basis. This is personal property, and there was nothing acquired, placed in service in the fourth quarter. So I'm going to use half-year convention. I'm going to use the default. Since there's no fourth quarter stuff, I definitely won't use mid-quarter. So if I go back, I'll use the half-year table, and I have a computer. Computers are 5-year property. So I'll look at 5 years. This is my half-year convention table. So in year 1, under 5-year property, I use 20%. Right? These are percentages. The table doesn't make it clear, right? So, right, if I'm using a calculator, it's going to be 0.2 for 20%. So on this one, I got that 20% rate from the table. I'll multiply it always by the original basis. So my depreciation for year 1 is $800. And I didn't put this in here. If we wanted to know year 2, could go back real quick. Year 2, right, is going to be 32%. It's going to be 32% times $4,000. right? So I'm not feeling very smart today, so I'm going to use a calculator. That would be $1,280 for year 2, right? It's nice and simple. When it could be slightly less simple is if I dispose of the asset while it still has basis left, right? I haven't fully recovered it. So if it's a half-year asset and I sell it early, I'll take the full year number and then I'll just multiply it by half, by 50%. Pretty simple. Mid-quarter, a little bit more complicated. I get half of the quarter that I sell it in, and then any quarters from the year before that, I get all of them. So if I sold an asset in July, right, before it was fully depreciated, I would get half of July and all of January through June. So I'd get 6.5 months out of 12. All right, so here's our tables. Let's suppose that Acme sells the computer on January of year 3 for $2,000. What would their, all right, so when I use this CRA, I mean cost recovery allowance. It's a short way to say it's the term because it covers depreciation or amortization or whatever, but just FYI, CRA means cost recovery allowance. Usually that's depreciation. So I still have my computer and I'm still going to use my initial basis of $4,000 to start. $4,000 times the year 3 number will be 19.2%. So that 19.2% times the $4,000 would be the full year, but because I sold it during year 3, I had to multiply it by half. I only get half, even though I sold it in January, it's half year conventional, I'll always get a half year. So their deduction that year would be $384. So remember we said in year 2, it would have been 1,280, just using the table in the same way. So from year 1, 2, and 3, my accumulated depreciation is then 2,464. That means my initial basis minus accumulated depreciation is an adjusted basis of 1,536. So now I have a gain of my amount realized minus adjusted basis gives me a gain of 464, right? Which would be taxable. And assume that in addition to the $4,000 computer they purchased on January 1st, they also purchased office furniture for $8,000 on November 10th. All right, so now what should pop out to me is now they've purchased an asset during the 4th quarter. So that triggers me to think whether the mid-quarter convention applies. I can eyeball this one that it does, right? But to be very clear, their total value of property placed in service during the year, the computer plus the furniture is $12,000. 40% of that number would be $4,800. So if they placed in service more than $4,800 during the 4th quarter, more than 40%, they have to use the mid-quarter convention on both assets. And we can see they did, right? 8,000 that was in the 4th quarter is more than 40% of the total. 8,000 is more than 4,800. So I have to use the mid-quarter convention now on the computer and the furniture. So the computer, we already determined from this table, is 5-year property. The furniture, right, office furniture, is 7-year property. So this is my mid-quarter table. So if we're thinking, once again, this is the first year when the assets were placed in service, as long as I look in the right column, they've applied the convention for me in year 1. So the computer was placed in service in the 1st quarter and it's 5-year property. So I'm going to use 35%. The furniture was in November in the fourth quarter, and it's 7-year property. So I'm going to use 3.57%. This table's better about showing you that these are percentages. So I take that 35%, right, is what we got. Yeah, 35%. Times the initial basis, right? I'm always using the initial basis. Times 35% is 1,400. The furniture, we take initial basis times that 3.57%, gives me 285.60, right? I could round that up, right? Probably would be better. All right, what about year 2? I'm going to do the same thing. I'm going to take initial basis, 4,000. In year 2, my percentage, right? Once I start in this column for the computer, I'll always be in this column. Year 2 will be 26%. Same with the furniture. I got started in this column, I'll always be in this column. So year 2 of the furniture will be 27.55%. So 26% for the computer, 27.55 for the furniture, gives me my depreciation for the second year, right? So these are deductions that will reduce their, right, taxable income. All right, what if Acme now sells the computer in June of year 3? What would the depreciation expense for the computer be in year 3? All right, so let's go to our tables here. So we said, all right, so they sell the computer in June. My instinct is going to be to go, June is the second quarter, and I look here, right? But that's not right. Because I acquired the computer in January in the first quarter, I always stay here. So my full year number is 15.6% for year 3 for the computer. You can see if I was doing the furniture, I'm going to always go back to the same column for it, 19.68%. So I got that 15.6% for the computer, but I sold it in June. Now this is where I use June. Because June is the second quarter, that means I get half of the second quarter and all of the first quarter, right? I'm going backwards because I'm selling it. I'm thinking about when did I own it. So I take the full year, right? I'm still always using the initial cost basis times the percentage times that 1.5 quarters out of 4 gives me my depreciation deduction for year 3 in the year of disposition, right? I have to do this fraction stuff because I sold it before it was fully depreciated. All right, more examples. Scrap Happy, our scrapbooking company, they bought the following assets and placed them in service. A machine cost $3,500, placed in service in April or the second quarter. A computer, $1,200, placed in service in October or the fourth quarter. All right, so it was fourth quarter. I have to think, does the mid-quarter convention apply? Well, I can see, right, pretty simple here, more than half, right, was not in the fourth quarter, right? More than, this is definitely not going to be more than 40%. I can eyeball that. The other thing I want to do, I have a machine and a computer. The computer, if you remember, is 5 years. Machinery is 7 years. So those are my recovery periods. Right, to be clear, right, the total assets purchased was 4,700. The fourth quarter assets of 1,200 equals 25.53%. That's less than 40, not more. And so I don't have to use the mid-quarter. I'll stick with the half-year convention. So if I'm under the half-year convention for this machine and computer, the computer is 5-year property. I'll use 20%. The machine is 7-year property. I'll use 14.29%. Some scrapbooking Google images for you. Pretty bleak. Okay. What if I take this same example, except I switch the prices? What if the machine purchased in the fourth quarter cost $3,500 and the computer cost $1,200? Now my math changes. Out of the $4,700 total, $3,500 was in the fourth quarter. That's almost 75%. It's definitely more than 40. Now I have to use the mid-quarter convention. So under mid-quarter, my machinery is 7-year property and it was fourth quarter, so it'll be 3.57%. The computer was second quarter, I think 5-year property, so it should be 25%. So 25% in both cases, I use the initial basis cost times the rate from the table, $300 depreciation deduction for the computer. Initial basis times the rate gives me $125 depreciation deduction for the machine. You're starting to get intrigued. You're starting to want to do some scrapbooking. Don't understand it myself. I don't get it, but I respect it. Okay. So now, right, let's say we're still with this example. It's still, right, we had enough in the fourth quarter that we're using the mid-quarter convention. We calculated year one. Now we're in year two and they sell the machine for $2,500. All right, so let's go back here. The machine was right here is where we started. So this is where we stay. Year two percentage is 27.55. So my full year convention would be full year depreciation will be initial basis times that percentage from the table, but they sold it early. When did they sell it? They sold it in January. That's the first quarter. So they get half of that quarter, and there was no quarters before that year. It's the first quarter. So they get 1/2 quarter out of 4. 1/2 over 4 out of times the full year depreciation amount gives them a deduction of $121 for the machine for the year. All right, so if I take my initial basis of the machine minus last year's depreciation minus this year's depreciation, I have an adjusted basis of $3,254. If they sold it for $2,500, that's the amount realized minus adjusted basis gives us a loss of $754, which, right, because it's a business use asset, they can deduct that loss. All right, so we've done personal property. We've showed sometimes its default is the half-year convention. Sometimes it's mid-quarter. Now let's look at real property. Real property is simpler in the sense that it's always the same convention. It's always mid-month, and it's the straight line method. All right, so you could almost calculate it without looking at the table. All right, so our recovery periods for real estate is, you can see, if it's residential real estate, it's 27.5 years. But maybe you're saying, what do you mean residential? I can't deduct my house, right? It's not a business asset, right? So this would be somebody owns an apartment building or, right, a house, right, that they rent out to others, right, in order to earn income. Their recovery period on that asset is 27.5 years. Now, most non-residential property is going to be, 39 years. All right, so these are really our two recovery periods. You can see if property was placed in service before May 13th, 1993, the recovery period for non-residential property is shorter, right? And some of this property is still out there it's not fully depreciated yet because it hasn't been 31.5 years. In all of our examples, we're going to assume it's placed in service after 1993, and we're going to use 39 for non-residential, 27.5 for residential. So it's pretty simple. So all we have to do on real estate really is figure out, is this residential or non-residential? Then I'll look at the right table. And then once I have the percentage from the table, it's the same thing. I take the original basis of that real estate asset times the percentage from the table for that year. And I'll always use the original basis. All right, so this is the residential table that we'll use. And here is our non-residential table. They condense it here, right, because it's straight line. It's the same every year in the middle. In the first and last year, they've applied the mid-month convention for us. We only have to apply it if we sell it in one of these middle years. All right, so Scrap Happy purchases a warehouse and the land it resides on for $170,000. And right, it's appraised so that $120,000 is allocated to the building, $50,000 to the land. We want to figure out their depreciation deduction for that in the first year. Let's see, so a warehouse, right? It's non-residential. So I'll look at the non-residential table. And the only other thing I need to know is, if I go back, when was it placed in service? On July 12th. So July of the 7th month, the percentage that I'll use is 1.177%. So I'll take that percentage times the original basis of the building, 1.17% times the original basis of the building, that's 0.01177, gives me a deduction of $1,412 for year one. Right, notice, right, we just used the original basis of the building. We left out the land, right? Land is not depreciable. Right, they'll make fun of you big time down at the firm if you try to depreciate land. All right, here's another example for real estate. A Lance company acquires a warehouse for $100,000 on April 1st, 2019. So once again, a warehouse is non-residential and it was acquired, right? And these examples are problems. If it doesn't say, if it just says acquires, you can also assume they place it in service at the same time. So for April, the 4th month, we'll use 1.819% times the original basis of the warehouse of 100,000. And also, right, if it doesn't tell us about the land that it's on, we'll just assume this number is for the building. All right, so 100,000 times 0.01819 gives us our depreciation deduction for the year. All right, what if now a Lance company disposes of the warehouse in year 2 on October? So just like with the mid-quarter convention, I'm always going to stick with the column where I started, right? It's especially wants to trick you on the months, right? Because I sold it in October, my first instinct is to go here, right? But I always want to stick here, right? It won't make a big difference if I'm in a middle year, because the number is always the same. So I probably just spent too much time on that. So my rate is going to be 2.564%, right? You can infer this is just 1 divided by 39. So I'm going to take that rate times my original basis. That would be the full year depreciation. But I sold it in October, so I get half of October and I get all of the months before that. So I get January through September plus half of October. So that's 9.5 out of the 12 months times the full year depreciation gives me a deduction for year 2 of $2,030. All right, so we're gonna stop right there to try to make these into more digestible segments.